Good evening, everyone. On behalf of Axis Bank, I welcome you to the 16th edition of Treasury Market Talks. Axis Bank has been instrumental in serving a wide spectrum of customers through its innovative financial solutions and products covering large and mid corporates, SMEs, agriculture, and retail businesses. The bank has leveraged the power of technology to provide uninterrupted, best in class service, benefiting its wide national base. We aim to equip clients with high quality input around emerging issues, and to this end have emerged as a well respected thought leader within the banking industry. As part of its thought leadership initiatives, Axis Bank has been organizing Treasury Market Talks, a talk series hosted by its corporate banking team on diverse topics such as central banking, fiscal policy, geopolitics, macroeconomics, and financial markets. We have been honored by the presence of many eminent speakers in the past as part of this initiative, notably Michael Pettis of Peking University, Pramit Pal Chaudhary of the Eurasia Group, Professor Otmar Ising, who was the founding chief economist of the ECB, and Baroness Ashton, former EU foreign policy chief, just to name a few. The talk series has been received very well by all stakeholders with great enthusiasm and participation from leaders in the corporate world and in other diverse fields. Our conversation today, Higher for Longer, is a look at US interest rates and their knock on effects globally. We are honored to welcome Professor Joseph Stiglitz of Columbia University and Chief Economist of the Roosevelt Group. Professor Stiglitz, as many of you might know, is a recipient of the Nobel Memorial Prize in Economic Sciences, a past Chief Economist of the World Bank, and former Chairman of the US President's Council of Economic Advisors. And I'm not going into his full bio over here, but there's a lot more. Speaking with Professor Stiglitz is Brijesh Chalil, Executive Vice President and Head of Treasury Market Sales at Axis Bank. Some housekeeping announcements before we begin. Participation in the webinar is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents of this webinar is strictly prohibited, and prior explicit permission of Axis Bank is imperative. As a reminder, all participant viewing panels will be in the view-only mode. Participants who wish to ask questions may post them on the question box on your screens. Please note that the conference is being recorded and may involve the presence of the press or media. On behalf of Axis Bank, I once again welcome all our customers to this event. I now hand over the forum to Brijesh. Thank you, and over to you, Brijesh.
Thank you, Tanay. Good evening and a very warm welcome to all of you joining us this evening for the 16th edition of Treasury Market Talks here at Axis. My name is Brijesh Chalil. I head the Treasury Sales business. We have with us, of course, Professor Joseph Stiglitz, full-time professor at Columbia University, a PhD from MIT, a Nobel laureate. He's been in the past the chief economist at World Bank, the chairman of the President's Council during the Bill Clinton era. He's also an author of some very iconic books, including Making Globalization Work. So it's great having you here. The last time, Professor, if you recollect, we met was almost 15 years ago. That was, I think, when you and Anya were here in Bombay. It was a different bank, different time, but let me just say this, that I'm as excited as I was then. Great to have you with us, Professor Stiglitz.
Nice to be here.
Thank you. So I think, for everyone, the timing of this call that we're having with Professor Stiglitz, we've been very lucky, fortunate, and we also probably timed it a bit. But, last evening was the FOMC Fed decision. For the last 2 months, the markets have been heaving and hawing about whether there's going to be a pause or there's going to be a hike. We all know, of course, now that last evening there was a pause. The Fed has decided to keep the rates in the band 5 to 5.25. This is the first time a pause has happened in 15 months across 10 FOMC meetings. But what's also keen to watch is, apart from the pause, all 12 members of the Fed actually also put up a request to look at 2 possible rate hikes coming up in this year. So, Professor Stiglitz, the question I have is, you've been very vocal and, especially on your thoughts around inflation. And I will come back to inflation. But for now, it would be great to kick off this session with your prelim thoughts around, last evening's FOMC decision.
Well, I think it reflects a great deal of uncertainty. They know that the effects of interest rate changes have long and variable lags. Usually we talk about 18 months. So they've set in place over the last 15 months, as you mentioned, a large number, one of the most rapid increases in interest rates, rapid and large. And there's just a lot of uncertainty about the magnitude of the fall-on effects. Some sectors have been hit very badly, like residential real estate. There are other areas that are weak in the economy, like commercial real estate. And there's just a lot of uncertainty on that side. And on the other side, there is uncertainty about what's happening to inflation. Inflation has come down much more rapidly than they had anticipated, but it's still not where they would like it to be. So I think it was the conflation of these two contradictory uncertainties. Is inflation already pretty well under tow? Being well managed on the one hand, and have they set into motion some effects that would lead to a hard landing? And one further complexity in the analysis is that, in the last few months, we've seen the consequences for financial turmoil in the United States with the bankruptcy of Silicon Valley Bank and a couple of other very large regional banks. And America is different from many of the European countries, Canada and Australia, in that we have a more diversified financial system, banking system. We don't just have 4, 6, even 10 dominant banks. We have several hundred banks, regional banks, local banks. I believe these regional and local banks play a very important role in our economy, make it more competitive. And there is now a debate going on, is the Fed trying to kill these banks? And of course, the Fed doesn't want to be seen doing that. A lot of politics in the local banks, as you can imagine. The congressmen representing these local areas are not happy. So there's both an economic and a political dimension to what is going on that have to be managed. If the local and regional banks don't lend, the U.S. has a greater likelihood of a hard landing.
Correct. There's no way we can not discuss inflation, when you're discussing the FOMC on the rate hike. We've heard the rhetoric from the Fed for a while about, their target rate of 2%. Although I must say I've not seen too much scientific evidence of, where or why that 2% is. And, I'd love to hear your thoughts around that. But, you did mention inflation coming down. And you're right. I mean, when we saw the last print, headline inflation print in the US was 4%. And that was much lower than, the 4.9 that we saw earlier. But if you look closer and, is the core CPI, the core inflation. And that's, I'm not saying it's not moved, but it's proving to be a little sticky. It's barely moved from 5.5 to 5.3%. And given what's happened, last evening, where on one hand the Fed did pause, on the other hand you had a unanimous decision to possibly look at 2 rate hikes. So what I'm possibly taking away is that the Fed is, in some sense, when they're looking at inflation, they're possibly looking at core inflation and not very happy with that. But again, surprisingly, if you heard what Powell said, he didn't say that they'd wait for more data, which was the stance that they'd taken for the last 2 months. They actually tweaked the stance to say that we're in a slower paced stage of rate hikes. So, Professor Stiglitz, you've always been, again, fairly vocal on your views on inflation, and you maintained that inflation is not, at least in this case, a demand side problem. It's a pandemic led supply inflation problem, which would of course go away sooner or later because inflation, the pandemic's gone now. But given how the Fed has reacted last evening, and the fact that we are kind of reverting back to a hiking cycle, how do you see the whole inflation story panning out? And have we got this whole story wrong on rate hikes and inflation?
So let me begin with the first question you posed. That 2% number was pulled out of thin air. It was just made up. There was no scientific evidence that that was the best model. There's been some recent research which has shown actually quite the contrary, that because there are asymmetries in adjustment, what we call when there's excess supply in the market, prices don't go down as much as they go up when there's shortages. Very hard to downward wage rigidities. It's very hard to cut wages. What moves resources from one sector to another is relative prices. And you have more scope for changing relative prices if you have a little bit more inflation. So I think the scientific view now today would be that we ought to have, given the magnitude of the structural transformation that our society and economy is going through, a higher inflation target of 3 or 4% would be better for the economy. And if we're almost there. We're almost there. So, and from that perspective, Powell is pursuing a false objective. I should also mention, just as there's no economic theory behind the 2%, there's no economic theory about how fast you should get to that 2%, even if you believe that 2%. It could take several years. So the idea that we should quickly pursue the 2% has even less validity than the 2%. So I think the Fed is going after the wrong objective. It actually is bad for our economy. So that's the first thing. Now, the second question is to understand the nature of this inflation, which is different from most of the inflation we've had in the last half century. I think everybody understands that this was an inflation that was at least started on the basis of supply side interruptions, supply chain problems, pandemic related demand shifts as well, and then the war in Ukraine. So that created enormous turmoil. And then we had one more element, which is because of that turmoil, many firms wound up in having monopoly power or market power. And they exercised that market power and they raised their prices, they raised their markups, and that too contributed in a predictable way to inflation. Let me just give you some examples. In the beginning of inflation, one of the big things, about a third, was cars. Now we know how to make cars. We have our factories, the same factories that we had before the pandemic are there now. What happened? The car companies forgot to order chips. But for a chip, you can't produce a car.
Right.
And because you couldn't produce cars, used car prices went up too.
Right.
Now, the car companies, I talked to them. I talked to the head of Volkswagen. They said, look, we have this problem under control. It's going to take us a while.
We'll solve it. Yeah.
But we will solve it. This is not a big deal. And guess what? They solved it. And now inventories in cars are going up, prices are going down, and it's disinflationary. Let me give you another example. The war in Ukraine shot prices of oil up to 120. they're now down back to 80. People are worried about, are they going to get even lower? OPEC is intervening
Got it.
to increase the prices.
Yeah.
So again, we didn't respond as fast as we should have. Europe didn't design its electricity prices in the way they should have, but it was something we got under control. And now there's disinflation from the coming down of energy prices, not as fast, but there it was. A third example, housing. In the midst of the pandemic, people didn't want to live where they wanted to live in different places. I mean, in New York, let me give you my apartment building, half the people left. I live in Manhattan. I should have said I live in Manhattan. And, it's a wonderful city. Any of you visit it, it's a wonderful place. But what makes it wonderful is seeing other people, going to plays, going to restaurants. In the pandemic, you can't do that. And it becomes a terrible place. And everybody wanted to go out to Southampton and Hudson Valley and out in the rural area. Well, you can't construct new houses overnight. And so the housing prices went up in Hudson Valley, Southampton, these other places, but they didn't come down in New York. And that's the asymmetry I mentioned in adjustment. So what happens? The average price goes up.
Right.
Now, it's not like we have more scarcity. We killed off more than 1 million Americans. I mean, we didn't kill them off, but that was tragic, but it was what COVID-19 did.
Yes.
And immigration stopped. So we actually, if you look at it from the aggregate point of view, we actually had excess supply. But because the supply was in the wrong place, we had housing inflation. So the point of that is now that is being resolved. People are coming back into New York, and the city is bubbling, and things are being more normalized. Well, so my prediction was that the disinflationary forces would come into play. Remember, prices will be higher, but the rate of increase in prices is going to come down.
Right.
And we made a mistake, those of us on our side of the debate made a mistake that we thought it was going to happen quickly. But we didn't understand that when you have just-in-time production, when you have very complex supply chain problems, resolving these doesn't take just a week or a month. I mean, we had some examples of lumber where it took a couple of weeks, but you get a complex product like chips, it can be 6 months, a year and a half. So we're now seeing those forces at play. Now, you asked about core. It's inevitable when you have these prices, whether it's non-core prices like food and energy,
Right.
They're going to seep into core. The economy is too interdependent that you're going to have those increases in prices. Eventually, core is going to go up. The question you have to ask is about wage price dynamics. And the thing we always worry about is a wage price spiral, that prices go up and then wages go up and then prices go up and wages go up.
But then, Professor, just to, cut in, so what I hear, what you're saying basically is right. We did see the supply-led inflation and now all of that is getting sorted. But now you're touching upon those parts which, are possibly leading to sticky core inflation. Wage inflation, for example, you can take wages up, but you can't take them down. I mean, you got to fire the people, right? So that's the only way you correct that. So how do you, so are you still, quite clear that, this inflation, boogeyman that we had all created is kind of on the fade. Is that what you would confidently say?
Yeah, that's exactly what I'm saying. That if we had an explosive wage price spiral, I would be very worried.
Right.
But that's not what we're seeing. What we're seeing is that wages are going up much less than prices, about half the rate of prices. And that means that there's a dampening. It's not going to happen overnight. And that's where we said how fast you're going to get to whatever your target is.
Right.
You have to think about how much damage. But the fact is, we have a stabilizing process,
Right.
and it's at work. We do not have an explosive process, and that is very reassuring. In fact, what my worry is on the other side, because wages are not increasing as fast as prices.
Okay.
Real wages are going down.
Yeah.
And America, as you may know, has an enormous amount of inequality,
Yeah.
the highest level of
Highest
inequality among
in the world.
of any of the advanced countries.
Yes.
And this is exacerbating it. Now, what we have to remember also about this particular episode, and this is a special episode of inflation, remember I mentioned before that markups had gone up. That is to say, firms had exercised their monopoly power, temporary monopoly power, because of all the supply side interruptions.
Right.
That's going to go away. When we get back to a more normal market, firms' market power is going to go down, but it's going to take a while.
Right.
And that means we can actually have wages go up faster than prices. They haven't happened. But what I want to warn the Fed about is typically their view is if wages go up faster than prices, they have a conniption. And
Yeah.
they get very, very worried. And what I'm saying is we want wages eventually to go up faster than prices because we want those markups to come down.
Right.
Because we want to restore the world as it was basically
Pre-COVID.
pandemic. In fact, we'd like real wages to go up, which means wages going up faster than prices over the medium term.
Well, that's so there's a bit of a kind of quandary there as well. Again, if you look at the data that's coming out of the US and specifically on employment, the last print on unemployment was 3.7%, which was higher than 3.4. So technically, it looks like the Fed's doing a good job. Their trust to kind of slow down the economy or cool the economy using their extension is playing well. But then last week's or 2 weeks ago, the non-farm payrolls data again stumped us because from 190,000 expected number, we hit 339,000. So the point I'm making is the data's a bit mixed, and especially around like you correctly said, I think wage inflation is and unemployment is something that we need to possibly look at a bit more closely. But if I were to simplify it, the initial view was pretty straightforward, and this is how markets kind of interpreted it, that we have a pandemic and there are supply side issues. It's caused inflation. The Fed came in late to the party, and what did they do? They just hiked aggressively, as we correctly saw. And the market said, with these hikes, you will cause a bit of a recession, self-induced, which will obviously control inflation, bring it down. And then the market actually factored the anti-recession rate hikes or rate cuts as well, right? I mean, a few months ago we were even looking at rate cuts, but the way it's actually panning out, instead of that kind of simplified version, is what you're seeing is some level of sticky inflation. You're seeing a kind of protracted battle where rates are still high and possibly looking higher. And yet you have an economy which is giving you mixed results, where you have wage inflation still there, and then you have but good non-farm payrolls data coming in. So the point I have is, where are we heading with this? if I, where's this all going to, what's the end game for the US when it comes to how is this going to play out? We've heard about soft landing, we heard about the hard landing. Now we are hearing about a softish landing. And when you throw in things like, the SVB, you alluded to the weak bank story, which was, pretty scary coming out of the US, which you think is, one of the stronger countries. So when you throw in that, when you throw in, the dysfunctional legislating about the debt ceiling, and when you throw all that, is America really ready for a recession? And can you handle it? So what do you think, Professor Stiglitz, is the end game of all of this?
Yeah. Before I answer the end game thing, let me make one comment about the reasoning of the Fed and another aspect where it's I think flawed. I talked about the first aspect where I think it's flawed, which is the focus on aggregate demand rather than the actual supply side demand shift, pandemic related, war related inflation. So they use the usual model rather than the special model.
Right.
The second problem that they have as they think about it is the standard macroeconomic relations that we call the Phillips curve and the Beveridge curve. And that's really very strong in their mindset, which is usually there's argued that there's a relationship between the level of unemployment and the inflation rate. And that leads to the view that you have to get the unemployment rate up if you're going to get inflation down. So that's predicated on a stable relationship between unemployment and inflation. Now, one of the things that we know is A, in general, that relationship is not stable, and B, in the context of the pandemic and the war, it is particularly unstable. And we've seen evidence of that. The inflation rate has come down much more dramatically than anybody that believed in the Phillips curve would have asserted. We see, looking at that data, the Phillips curve is changed or shifted or is not like it was before. So the whole reasoning of the Fed is misguided. But you investors need to be concerned about how they think, not what they should think. So we're trying to predict. And I should tell you that inside the Fed, from people I know on the board, some of them share my views and many of them do not. So I think what you're going to see is, until now, there's been broad consensus that you can't look at the vote because they always get a unanimous vote. But there's been broad consensus that they have to be seen to be fighting inflation. Now there's more of a debate because they also have to be seen to be caring about the American economy. And that comes to your question about where we're going to have a hard landing or a soft landing.
Softish landing.
Or softish landing. And what makes it more complicated, first, you every reason to be concerned about the gridlock in Congress, about the debt fight that we just had.
Yes.
But that was mostly a charade.
Charade. Happens every year.
It was political theater.
Yes.
Very good political theater. If you're in the outside, not so much if you're in the inside. I would not have wanted to be engaged in the bargaining, but Biden showed wisdom in that he got for the next 2 years really what he wanted. Yeah. And, we always live a little bit day to day in this kind of gridlock world we live in. So what I see right now, and things could blow up with this Republican extremist that we have. So, nothing is guaranteed. But this is what I see things. We have on the one side, very strong fiscal policy for from the measures that were adopted in the first 2 years of the Biden administration. I mean, it was a really impressive 2 years. We had, beyond the American Recovery Act, we had the CHIPS Act, the IRA, we had the infrastructure bill. These are three bills of each of them hundreds of billions of dollars.
Right, yeah.
And the administration has shown itself to be very competent, not only in getting legislation, but in implementing it. The money seems to be flowing. And by all reports, there's a real boom going on in many of the places where the money is being targeted. So that's on the upside. And
Right.
then, as we say, the rate increase is on the downside. So it's a pull between these two effects. Meanwhile, we are being normalized. We're moving into the post-pandemic world, and you feel in the United States a process of normalization, I would say. I think we have worries about the external environment, that Europe's economy is weak,
Yeah.
China's economy is weak. We are a big exporting country. And if our trading partners are weak, that will also be a negative on our economy.
Right.
And that's why I think the view that you talked about, which is a softish landing, is probably right. And it will be complex with some parts of the country very soft and almost hard, and some parts, doing rather well. There's one more thing that or more than one more thing that I could have talked about. There are growing anxieties about our commercial real estate market.
Okay.
The pandemic, I talked about the changes in the patterns of demand that the pandemic set off. Some of them were temporary, like moving into more rural areas, more beautiful places, and now they're coming back to New York and to other cities. But some of them, like Zoom or WebEx, like we're on now, are going to be permanent.
Yeah.
And the norm in the United States, I don't know what it's like in India, but the norm in the United States now is people going in the office 2-3 days a week. And, companies are saying, we're not going to pay for all that real estate for people coming in for 2 or 3 days a week. And that means there will be an excess supply of real estate, and real estate, there was just, and it's showing up in other aspects. Just an article yesterday in the paper illustrated that because people aren't coming into the city shopping malls that depended on foot traffic are not doing very well. And one of the big one in San Francisco just went bankrupt. So we're getting signs of tremors in a whole
Real
set
estate.
of real estate.
But what about the banking crisis? Do you think we're broadly done with that? And some of the weak banks, of course, did fold up. But is that behind us now, Professor Stiglitz?
No, I don't think it's fully behind us, and that's one of the reasons for the pause. I think they got scared of what might happen if they continued, and they wanted to look more carefully. The price of the shares in the regional banks and the local banks reflects an anxiety. Two things that happened. Some of the banks, these local banks, their portfolio is disproportionately in real estate. They're local banks.
Right.
And they know about it. And I just described one aspect of the real estate market, the commercial real estate. So, that can vary from one bank to another. So on the asset side, they have a problem. They also have a problem on the liability side,
Okay.
because as you know, most banks depend on deposits, and deposits used to be pretty sticky. And with the internet, deposits have become much less sticky. It was one thing when interest rates were zero. People didn't care where their money was.
Yes.
Whether it's zero or 0.1 or 0.15,
But then
it wasn't worth thinking.
So this, I mean, not to digress, but this is incidentally a problem, Professor Stiglitz, that's happening in India, of course, for different reasons. The credit offtake here is about 15-16%, and the deposit book's only been growing at 10%. So there's a bit of a gap. So actually, this is a problem we have back home. But what I'm curious is, if the money's not going to the banks in the US, but with rates being high, so where do you think all that money is going?
Well, let me qualify. Question you asked first was one of stability.
Right, absolutely.
And the concern about stability is that money can be withdrawn at a moment's notice from a bank.
Right.
And if you're getting 3%, but you think the bank may go bankrupt, even if it's insured, you don't want to go through the hassle. You don't want to go through the anxiety. So, but if it's not insured, you definitely will take your money out. And that's what we saw in Silicon Valley Bank. $40 billion went out in one day.
Yes, it was institutional money, but yes, it still was a lot of money to leave in 24 hours.
Oh, it's not just institutional money. It was corporate money. It was the large individual depositors. And by the way, in that particular case, I know for a fact because my daughter is one of the Silicon Valley entrepreneurs. She tried to take her money out, and the program wouldn't allow her to.
That's scary.
It crashed. So it was you can imagine how scary it was for her all the things that she worked on.
I mean, for anyone, the point of putting money in a bank is, safety first. You're not investing in equity markets or some, scheme where you're expecting some high returns. So I hear that. So Professor, just to kind of summarize this point, would it be fair to say that, that inflation, of course, is, the 2% handle doesn't hold true. It's probably likely to be 3 or 4%. And, inflation at that level is probably good. It's important that wage inflation, probably goes up a bit. It's important so that, there's some real positivity there. And on the hard landing, you're looking at something in the middle, softish, so not too bad. But yes, it could be hard in parts. And, we'd still have to keep an eye out for, some of the bank crises, which could possibly be linked to, the real estate, potential issue that could come up, right?
Yes, that's right.
So on the, you mentioned, Europe, and, I recollect your 2016 book. You were quite critical. The euro, the common currency threatens the future of Europe, right? And I think, what I recollect from the book, Professor, was, while you had critically outlined, Europe's flawed architecture, their tilt towards neoliberalism, I think somewhere you also had your last few chapters where you spoke about the way out, and there is a certain sense of solidarity that is required, which I think is not there today. And so, with that as a backdrop, where we have we have the weak foundations of the euro, and I would say the weak foundations of the whole Europe architecture. Now, to top that situation, moving to where we are today, we're in a situation where America has pushed up rates aggressively. We're still in a high inflation era. There's a war going on in their, background. There's an oil energy crisis that's still, 70, $80. It's still high. So what is, honestly, the future of Europe isn't looking too exciting. So, how do you see, both the region and the currency play out, Professor?
Well, first I'd say I was very impressed with Europe's cohesive solidarity in responding to the pandemic and to the war. And so that has been a very strong force bringing Europe together. And as I said at the end of my book, that's the kind of thing you need for the euro to work. So that's on the positive side. On the negative side, and it hasn't yet shown its face, and I just worry about when it will show its face. When you have 1% or zero interest rates, the level of the different levels of debt of the different European countries doesn't matter. And they can manage debt. Zero interest rate, anybody can manage any amount of debt.
Absolutely.
But if rates, if the Fed rate gets up to 5-6, it's already 5, gets up to 6%, say,
going to hurt someone.
The interest rate on Italian or Greek or some of the more risky bonds in Europe, if they were not supported by the ECB, would get very high.
Yeah.
And think of an interest rate of even 5%, 6%. Italy has now a debt GDP ratio of maybe 100. I can't remember the current number, but it's like 140% or maybe even more. That means they're going to be spending 7% of their GDP just servicing the debt.
Mm-hmm.
For a country that normally, given the amounts of tax revenue, that's going to be an enormous contractionary force. It's going to be an enormous burden. Now, right now, it's not a burden because a lot of the debt is long-term and a lot of the debt is held by the ECB, and so it can be managed. But over the long term, even long-term bonds become due and get renewed, rolled over, and the higher interest rates. And is the ECB going to remain the lender of last resort to the Italian government? So this is, I'm just using that as an illustration that I don't think the euro is out of the woods. I think the problems are buried underneath, but they're there and they have not yet really been fundamentally addressed.
So you wouldn't be too bullish right now then, from a mid to long term perspective, both on the region and on the currency, right? Especially the euro.
I think what I'm saying is there are certain long-term political issues that are really crucial. The solidarity that we saw in COVID and in the war is works to the other side. So, if I had looked at the experience in Europe, always does the right thing at the last minute. So balancing my worries are that somehow they're going to do a patch-up job. But all of it says it's not great for the economy. It'll survive, it'll muddle along, but it doesn't make for a very optimistic note.
Yeah.
The only source of optimism, one has to look at this in relative terms, and one has to recognize that there is a chance that Trump, a person who is been indicted in New York and federal charges will become the president in spite of all that.
Yeah.
And he would try to destroy our democracy, and America will be in turmoil. So, when you make wagers on currencies, you're looking at not just one country, but you have to look at all the countries. And the imminent problem in the United States within a year and a half, 2 years, I view as a much graver risk than the euro risk.
Which one did you say? Sorry.
I view the American political risk as a much graver and more imminent risk.
Wow.
Than the euro risk.
That is not what I was at least thinking was the answer, but that's I don't know whether it's heartening to know, but yes, I think we need to watch US more closely. So
from my personal point of view, I hope this doesn't come to play. I mean, I'm not saying what I would like to happen. For me, it's a nightmare.
Right.
But anybody looking at the polls has to have a little more than a little grain of worry when I think the markets have not really taken into account a appropriate bearish stance on the United States, given where the politics, I don't say headed, but where there's a not insignificant probability that it will go in the wrong direction.
Got it. So, just extending that, thank you for that, kind of summary on Europe. But you're right, you kind of came back to the US and, if I just extend that to the rest of the world, we used to always jokingly say, right? They say when America sneezes, the rest of the world catches a cold. And here we are in the midst of aggressive rate hikes by the US, which, as we speak, doesn't seem to come to an end. So, and we've already seen an impact of this on the currency. We saw the dollar index, last year move from 94 to 114, and the combined effect of all of this, which is primarily rate driven, which, mind you, we're talking about a 15-year low rate era, right? And it's there for all of us to see around us the impact. I mean, back here in India, we've seen Sri Lanka, Bangladesh, Pakistan, and Turkey and Argentina as well, right? I think even at back home in India, it almost cost us, Professor, almost $1 billion to keep of our reserves to keep our currency stable. It was only thanks to, I would say, some robust policies and handling by the RBI that we actually managed to kind of hold out, and now thankfully we've reversed the trend and the flows back. But the point I'm asking you is, the knock-on effects of this high rate policy, that regime that has been around. How do you see that impacting emerging markets, and especially South Asia? And any advice on policy measures that you could share?
Well, I've been very concerned, and one of the reasons I've been critical of the Fed is that it has not taken into account these externalities on the rest of the world. What they say, and it's what Paul Volcker said to one of my friends when he was on the Federal Reserve Board. And said he's worried about a Latin American crisis, which happened. He said, that's not my problem. His mandate was the U.S. economy. And it's only if these reverberations from abroad affect the U.S. economy should we take them into account. Now, I think that's an extremist view, but that's what the Fed's mandate is. And when other countries have to realize how selfish, in a sense, the U.S. is in its economic policy. And the Fed has shown total disregard, I think, of these other countries. And these effects, I think, are very adverse. One of the reasons they're very adverse is even in Europe, which is not in the same position, obviously, as Sri Lanka, even in Europe, the economy was weak, was fighting a war, oil prices were and gas prices were soaring through the roof. Raising interest rates in that environment, Europe had to respond by raising their interest rates. If they didn't, the currency would devalue and inflation would get even worse. But that meant their economy was further weakening. Germany is technically in a recession. And I blame in part the US monetary policy for causing that. But when you look around the world at small developing countries, you see several things going on simultaneously. Higher interest rates, which is high, in the context of high levels of indebtedness, because, as you said, the zero interest rate era, money was pushed on these countries, and I can say literally pushed. And thirdly, much of that debt is dollar denominated, and when the value of the exchange rate goes up, it becomes even more difficult for them to service that debt. Right. And the IMF estimates, the number of countries on the watch list just keeps growing and growing. So most of them are small countries, so it's not likely to build up into a systemic crisis. But for the people in the country, it's devastating. And for global geopolitics, it's devastating. One aspect of this global geopolitics, I very strongly support the stance that Europe and the US has in the fight against Russia on Ukraine. We can't just let one country invade another. I mean, what happens to the international rule of law? But I've been very disappointed at the position taken by so many in the South. And one of the explanation of that position is, look, you didn't pay attention to our problems. You didn't waive the IPR for COVID-19 as India had requested at the WTO. Now we're being afflicted by high food prices, high energy prices. And what are you doing for us? And then you have, on top of all that, you increase the interest rates, making our life even more difficult in a very rapid way, with showing no sense and no help. So I understand a little bit, but as I say, I'm not happy with that, with the position that they've taken.
So there's not much that, emerging markets could do. Of course, sadly, even though many countries like, say, Bangladesh, which was having a good export-led economy, of course, many of them would kind of get back on their feet, but, it pushes them 4 or 5 years back, right? So any, kind of general advice or policy measures that, as an economist, that you would generally recommend?
Well, going forward, there are some important messages, but going back, there's an old joke about, where should we go? And the answer is, don't start from here. But going forward, countries have to be very cautious about getting into debt. They should do everything they can to increase the domestic savings rates, so they aren't as reliant on foreign debt. Right. And that I think is an important lesson. And the most successful countries in the world have managed their way through high savings rates. So I think that's an important lesson.
So going back. So it's back to those basics of, obviously building your reserves, building your savings, and relying less on external debt, because then the currency quotient can at least be taken out of the debt, right?
That's right. What I was going to say is that if you do borrow in the domestic currency, because then you don't have the exchange rate effect, and you can at least hope that the government can modulate the interest rate effects.
And that's good advice. We did have a bond market called the Indian Masala bonds, which never really took off, but that basically, ended up as rupee borrowings for external candidates. But anyway, we might look at that again. Uh, you know, I have, today we can't ask a question about the US without discussing China. So though it's higher for more and longer and all of that, these are the two largest economies, and we've seen both of them play, trade wars. There's sanctions, there's tariffs, and strangely enough, it's also led to this, whole world of reverse globalization, if I can call it that. Every country is trying to be self-sufficient in their own ways, rework their supply chains, not to do what economically makes sense, but mostly around to suit their geopolitical risks. And also, we're at the same time, and since I mentioned China, we're seeing a divergent view there, where you're actually seeing rate cuts. They cut rates by 10 basis to 265. They just announced the 33 billion, financial infusion plan. So the question I have, Professor Stiglitz, is how do you see, the Chinese economy, and especially in this, deglobalized world where there's a kind of it's a US-China trade war. What will it be finally, or what's the impact on both countries?
Well, I think the reality is that there is this new Cold War, whatever you want to call it. And it's the only thing that Democrats and the Republicans agree on in the United States. And that has one very important implication. It's going to be very difficult for either party to back off, because as soon as they back off a little bit, the other party will slam them.
Yeah.
So I'm afraid that this is not only going to continue, it may get worse as a victim of the kind of political antipathy between the two parties in the United States. So that's the reality. It has meant that the international rule of law, as we had known it, has been just trampled. I think maybe that's the best word for it. The U.S. just went ahead and provided subsidies, protectionist measures, after it wrote the rules to say that those are not allowed.
Right.
So it had written the rules effectively, and now and it refuses to allow judges to be appointed to the WTO. So I think there's no other word to say that the international rule of law has been trampled, and at least for the United States. Other countries, if they do it, might get punished, but
you can't punish the teacher. Who's going to punish the teacher, right?
Yeah, exactly. So the way Europe puts it, I think, is the way best to think about it. Europe has said we are de-risking.
Right.
And not decoupling, but de-risking. And by that, what they mean is we recognize that there is a significant probability that there will be a decoupling, and that we can't be dependent for anything vital on China. And that they had made a very big mistake, they now recognize, in being so dependent on Russian gas. And they don't want to have that happen again. So they want to make sure that if there's something they're getting from China, it's either not important, or they could quickly get alternative supplies, or they could produce it at home. So I think that's the correct, you might say, mentality to think about what is going to be going on. The U.S. will go a little bit further because of the
politics, local politics and everything. They continue
the
to
local politics, but fundamentally we are very interdependent, especially in the short run. We're trying to move green. Green transition is a big part of our agenda, but all the minerals that we need for batteries and even windmills come from China. So we've created a world, an economy that's totally dependent on China. At the same time that we're saying we're having this antipathy to China. So it's a very strange world we live in.
Yeah, I know they're joined at the hip, and they can't actually get away from each other. But are you concerned with what's happening in China, or do you think it's a blip and they'll come through pretty soon? With the low growth and the cuts and the what's happening there.
I am concerned, and the part of the reason. Let me put it in context. Very, very long time, 15 years, 10 years at least, China has said it wanted to move away from export dependent growth
Right.
and to be more domestically driven. It's a huge economy, so if it's managed well, they could do well. So and this and the pandemic and the U.S. antipathy has helped move them in that direction. They've but on the other hand, they haven't yet achieved the kind of scientific, advanced technology advantage in most areas that the US and Europe have. In a few, like AI, they are very much on the frontier. But in many other areas, like making the smallest chips, they are years away. So, and then there's one more complexity that I'll add, which is steering a big economy involves lots of political decisions. We've been talking about it. You might call it a policy decision, the interest rate in the U.S.
Yes.
We talked about the politics of the Republicans and Democrats and the fiscal policy. Well, China, we don't. It is a little bit obscure to most of us, but what is clear that Xi has disproportionate weight in the economic decisions. Some people say he has all the weight, but he doesn't really know economics. And so the question is, to whom does he turn? And I think there is a certain lack of confidence on that front.
And anyway, I do hope that they reach out to a Nobel laureate I know who should be sharing some of his views. But thank you for that. Incidentally, while we were talking, I was just looking at Bloomberg hikes and Bloomberg updates, and ECB's just hiked, by the way, by 25 basis.
So not a surprise. They had been behind the U.S. and yes, so and their inflation is not quite as muted as the United States.
Yeah.
So that's not a surprise. From a global point of view, you were asking the global. It's bad for the developing countries because Europe and the U.S. can afford it, but it imposes high costs on the debtor countries.
Yeah, Professor, I can see quite a few questions. We might not have time for all of them, but what I'm going to do is, I'm in a minute, I'm going to request, Tanay to come in with a few questions that we would have. But I'm going to, ask you to kind of, if you would like to kind of summarize what you've kind of, shared with us. I mean, I could. My broad takeaway was that, the whole 2% inflation is not necessarily scientific, and it should be higher. And the US would eventually have, softest landing with some hard parts. And yes, the US policy with knock-on effects is definitely, hurting the world. And yes, it's been done slightly selfishly. But, with the new era of deglobalization, every country, is out looking out for themselves. But on the main topic, which is key on rates, whether they're going to stay higher, I think the takeaway from you, Professor Stiglitz, is that we're in for an era where the inflation could come down, according to you, quite sharply, and then all of the rate hike story goes away, and we could come back to normal. So it's not something that we need to worry about, but the journey could be slightly protracted and not maybe very soon. Am I kind of summarizing this accurately?
That's right. Especially on the last point, the wage price dynamics are stable, but they are not such that their inflation is going to come down very quickly to the target that the Fed sets. Now, remember what I said, they had the wrong target, but a very large fraction of the Fed is going to stick to that 2% target and
Right.
going to stick with this misguided view that it ought to be obtained in relatively short time. They believe their credibility is at stake. That's the kind of words they use. I believe their credibility is at stake in another way, that if they lead to an excessive hard landing, their credibility is weakened. The failures that they did in regulation, the failure of SVB, the Silicon Valley Bank, all have undermined their credibility. So my view, the credibility of the Federal Reserve has already been very badly undermined by the rapid high and rapid rate increases in interest rate. But that's not their view. So from the point of view of an investor, you have to ask not what they should do, but what they are likely to do. And I think what they are likely to do is continue on the course that you suggested was likely. And I think that consensus view is almost surely correct.
Great, thank you. So, Tanay, are you there with us?
Yes, Prajesh. Hi.
Do we have any questions from customers? Because I could see some pings coming up on my
We
screen.
have many questions. The first one is incidentally about credibility itself.
Okay, all yours.
It's from Ramana Wipro. He says the Fed has been a little unstable over the past 2 or 3 years. They first, got transitory inflation wrong. Then they hiked very aggressively. Then they thought they'd pause. So the Canadians, the Australians also paused. And now they're back to hiking. And it's not just the Fed. It's all global banks. So what's going on here, and when can things get back to normal?
And maybe
Well,
has
first of all,
the leader of the pack got it right, because the Fed is
Yes.
leading, and
Yes.
if they're leading everyone down the wrong way, Professor, which is then worrisome.
yeah. So my view that you mentioned in the very beginning of your talk, and I hear a lot, which is the Fed got behind the ball, let inflation get out of control, and risked losing their credibility. And that was true of other central banks. I think that story has no merit to it. In fact, there's been a study that looks at whether the countries where their central banks acted early have done any better than the countries that have acted late. And the answer is no, they've actually done, in some cases, worse. And the reason is the inflation is not demand side inflation.
Yeah.
No matter what you did as a central bank, oil prices are going to go up. Nothing you can do about that as a central banker. That's not your job. Auto prices went up. You could have reduced the demand for automobiles by absolutely killing the economy. But the cure is worse than the disease. So you don't want to go after that particular problem by a aggregate macro blunt tool like the interest rate.
Got it.
So my judgment, and this is really maybe more nuanced than the markets often take, is whenever you're making policy, you do it under uncertainty. You know, you don't know exactly. The data, it's about where the future. You're making judgments of the relative importance of supply side factors and demand side factors. In this case, it was pretty clear it was supply side factors. And the only mistake they made, I think, in the early days was to be more confident about how transitory they were. They were transitory, as I said before in my remarks. They just were not as transitory. You know, the car production is up, car prices are down, energy prices are down. So they were transitory, but it took a lot longer than was anticipated.
Got it.
Thanks, Professor. The next question, I'm combining two questions. One is Nitin Parikh from Hindalco. The other is Renu Bala from Hindalco. You've been a critic of rapid financial market opening in developing countries. And it's all the more relevant now, given that in the past 10 years, when everything was easy, a lot of countries really opened up and had money pushed onto them. And you speak about, increasing domestic savings and so on and so forth. Does this also involve a growth sacrifice? And is the future a lower growth future for emerging markets like us?
Well, I think the first part of the question raised a very important point. I think for developing countries, having fully open capital markets is a mistake because particularly, and when I'm talking about that, I'm talking about short-term capital, not foreign direct investment. But short-term capital flows in and then flows out. And so when the US government is monetary policy is extraordinarily loose as it was after the 2008 recession, money flowed in to developing countries. It was looking someplace to get a return, and it led to high exchange rates that made it very difficult for them to compete in many of the commodities, but it also made them very vulnerable. And we're seeing that vulnerability now because as the interest rates increase, the money is flowing out. And in my book, Globalization is Discontent, I warned about that kind of capital market liberalization. The IMF, in the aftermath of the 2008 crisis, actually agreed that you need capital account management. Where there's a disagreement now is exactly how extensive it should be, what form it should take, when it should be put into place. But it's very clear that unmanaged capital account flows coming in and out can be very destabilizing, especially if you're a small country.
Okay, so then do we look at slower growth going ahead?
Yeah, well, global growth going ahead has been ratcheted down, I'm afraid. It slowed after the 2008 crisis. It's likely to slow down now. I think there are a couple of factors contributing to that short-run slowdown. I think the decoupling or de-risking that I described is not going to be good for global growth. I think there's going to be a lot of effort put into restructuring the supply chains, and that's when they do that. We had high growth, but associated with extraordinary high levels of risk, and we're going to get a better balance now. But that's going to mean, in the short run, lower growth. There are some factors that in the medium term lead me to be more optimistic, and that is the US is finally recognizing the importance of research and money that for research that's related to productivity, to chips and so forth, has been put into the IRA and the CHIPS Act. And I think more broadly, the U.S. has become committed to what you might call industrial policy. The government needs to take a role in promoting economic growth. It won't happen overnight. The green transition is going to be an enormous opportunity for higher growth as people explore new ways. Just think about how much the cost of energy has come down as a result of renewables, about 80% in just 10 years. I mean, it's just extraordinary. So I'm hopeful that over the medium term, this renewed recognition of the role of government in supporting basic research, applied research, and the green transition all together are going to usher us into a level of higher growth than we otherwise would have been. But for the short run, it's going to be difficult.
Thanks, Professor. Following the FOMC and the ECB, we have a question from Basant Kumar Pasari of ONGC Pradesh. He asks, we're now at the peak rate or coming to the peak rate, but what is the neutral rate? Like when they cut, what level will they cut to? Will it go back to 0, 2, 2.5, like they've said? Fed funds futures say 3.75 as of now. And will the USD eventually, after all this is over, be stronger or weaker than where we are now?
Good question, actually.
Well, those are great questions. And they deal with the long run. And part of that, when you start dealing with the long run, you have to start thinking about demography, AI, robotization. There are several forces at play that go in different directions. For instance, I think that if you focused on robotization, AI, it's going to lead to an excess supply of labor. They're going to replace labor, and we're going to have a problem, a labor shortage. For the next 25 years, that labor shortage can be absorbed if we manage it well in the green transition. I'm not sure we're going to manage it well, but if we managed it well, as the labor gets released, it will be used for the green transition. But going beyond that, I think that there will be a problem. And that excess labor is going to mean that to generate full employment, we're going to have low real interest rates. Unless societal norms change, and I think good chance they will. In the United States, we went from probably a 60-hour week to a 40-hour week, and now we're around a 35-hour week. We could go down to a 20-hour week. Women entered the labor force. That was a big increase in the labor supply. That was a momentous change. But now we're going to another possible momentous change, going to a shorter work week and adapting ourselves to maybe a life that has more leisure, where we can spend more time thinking about what we really enjoy doing.
So net to summarize, on the dollar, what did you say, Professor? That is it going to be a weaker dollar or a stronger dollar going forward?
I think I hate to be a two-armed economist, but I am. So I mentioned before the real risk to our democracy that Donald Trump and the Republicans represent. It is a real risk. Nobody should pretend that it's not. These people do not believe in democracy. They do not believe in the rule of law. We had the insurrection. 2 weeks later, they were saying it was a peaceful march. to me, it's unbelievable. I never thought I would live to see the day that where one of the two parties was this kind of extreme fascist party. So that's the downside risk that we face, and it is real. On the other hand, I've never seen the young people that I interact with are so lively, so interesting, so dynamic, so creative that if we push off this danger and we resolve these problems at the bottom that we have, extremism that we have,
Right.
then I think the U.S. Has an enormous capacity for innovation and growth, and we'll have a strong dollar. So the one other thing when you talk about strong dollar, remember these are all relative currencies, in particular relative to the euro, which we talked about before.
Right.
I think well, I'm bullish because of the solidarity that was shown with COVID-19 and the war. The inherent problem of the euro are very deep, and as I said before, it's going to muddle along. And so, if we get the positive resolution of the political conflict in the United States, then I think we're going to see a strong dollar. The other side, we're going to see a weak dollar.
Got it.
Okay, I'll take one last question, and since we're on the dollar, I'll ask one about that. This is from Sandeep Nargas of HMEL. So de-dollarization is something everyone talks about today, and part of what the US does in terms of interest rates and everything is because the dollar is the exorbitant privileged currency. How do we preserve this? Is the old Washington consensus of having a strong dollar but not talking about it still there? Is that also part of geopolitics right now?
Well, I think the reason that the dollar is held so much, is as much that it is a good store of value. It's being stable, and U.S. is a stable country. That was put into question by the attempt of the Republicans to hold up the country in the debt negotiations that we just finished. And that goes back to the politics that I mentioned. Overall, I think that the dollar is going to remain if it turns out that we solve our political problem, which I'm very hopeful of. Then,
so I think you brought that back a couple of times. So I think it's U.S. politics that you think is actually going to decide in many senses whether obviously the rate policies, it's going to impact how they react with China. It also is apparently, according to you, deciding the fate of the U.S. dollar itself. So I think the next U.S. polls are something that we have to very closely watch.
That's right, and it's not just the polls. The vagaries. Who knows what happens? It's going to be very unpredictable.
Yeah.
What happens is there going to be a conviction? Are there going to be riots? There's so many dimensions that to our politics that even if we're living in the United States, are unknowable.
Great. Tanay, anything else?
Yeah, that's actually a very interesting question, which if I can slip in at the end. So this is from Mr. Srinivas Singaraju of Coromandel. He asks, you've disagreed publicly with trade agreements like the TPP, TTIP, and the like, and India is focusing heavily on trade agreements and trade treaties, and we also want to trade more in services and have fair movement of people because that's what our strengths are. Why do you think trade agreements are bad, and how should we proceed?
Well, the problem with free trade agreements is they really weren't free trade agreements. They were managed trade agreements, and they were managed for the interest of corporate interest and special corporate interest. Let me give you an example. One of the things buried in TPP were provisions on access to pharmaceuticals, to drugs. And they made access to generics more difficult. The reason for it was that the big pharma had much more influence in the U.S. trade representative, our trade minister, than did the generics. India has a fantastic generics industry, and that trade agreement would have hurt your generics industry. It would have gone right at it. Now, the interesting thing is that when the countries, when Trump withdrew from the TPP and the other countries got together, and they did make a trade agreement, one of the things they dropped were these health provisions. They were these intellectual property provisions. They were put there explicitly to help big pharma. And of course, when the U.S. wasn't there, big pharma wasn't there. I called a meeting of all the health negotiators for TPP, and I try to explain, our objective is economics, but also it's health. And we have government budgets we have to worry about. If you have to spend a lot of money on high-priced drugs, then you have less money to spend on others. So they were all there, except for one country, the United States. It did not want to discuss with me the arguments. All the other countries were agreeing with me. And the United States did not want to be put in the obvious position of being so unreasonable. So that's just one example of a provision in the trade agreement that I thought was bad for our society. There are also provisions about environmental regulations, whether we could actually take certain actions to promote the green transition. There were real worries the way the agreements were written that would impede our ability to pass laws that would facilitate the green transition. So that was why I opposed very strongly the TPP. It wasn't that, I think trade is a good thing, but it has to be, you might say, managed not for corporate interest, but for societal interest. And that was where the battle was.
I think, thank you, Professor, for this. And but I must say, before we end for the evening, Professor Stiglitz, you've always, you're always known as someone who speaks his mind. And, I would have said straight from the heart, but in your case, it's heart and the mind because, because of who you are. So first of all, thank you for this wonderful evening. And hopefully the Treasury Market Talks, today is the webinar, and at some point, we'd love to, host you in person. But, before we sign off, is there anything that you'd like to say to the audience? Any anecdote, any story, anything that you'd like to leave behind?
All I can say is I wish I could be back in India. I before the pandemic, we were coming once, twice a year. We always enjoyed our visits. It was, it was so exciting in so many ways. So it's been part of my life. The first trip I took to India was actually part of my honeymoon in 1967. And, I just remember it so vividly, traveled all over India then. And one of my roommates from college wound up being head of the Delhi School of Economics. And he wasn't yet, he was still young like I was at the time. And I stayed with him. And we had an absolutely marvelous time. So it's been 55 years I've been coming to the country, and I look forward to coming back again.
Oh, yes, we'd definitely look forward to that. And when you're coming down next, we'll probably convert the webinar into an in-person one. I'm sure a lot of customers also would love to meet and interact with you. Thank you, Professor Stiglitz. And it was lovely having you. Have a great day ahead. Thank you. And bye from all of us.
Bye.
Thank you very much. On behalf of Axis Bank, this concludes the discussion. I would like to take a moment to convey our gratitude to Professor Stiglitz and Brajesh Chalil for their time and the benefit of their experiences. We look forward to our customers joining us soon for the next edition of Treasury Market Talks. A recording of this discussion will be available in case you wish to have this passed on to your colleagues. Do connect with your relationship managers for help. Once again, thank you all for joining us. You may now log out from the webinar.
Bye.